It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Yes, Managing Your Financial Future. Welcome back. Another episode already. Wow, it's been a week. And what a week it's been. Man, oh man, Professor Plum, there's just stuff all over the news. And even people who are listening to this a month and a half from when we're recording it, I still think that statement is going to be true. That's all kinds of stuff going on in the news, all kinds of things that you think would rock the markets, rollick the markets, send them going one way or the other.
But when in history has that not been a true statement?
It really, I can't think of a time where it hasn't. I mean, haven't there been wars? Yes, the Ukraine thing,
but there's
fuel
also
and all that.
Unexpected things.
Mm-hmm.
People could see Putin being crazy for quite a while, and it was just a matter of time before he did something.
I think
stupid.
we've always known
he was a little loose cannon out there. But there are also a lot of things that roil the market, especially for short terms, that you have no concept of what's going to happen tomorrow, and whether it's tomorrow from the day I'm broadcasting here or recording, or whether it's tomorrow from the day that you're listening to this.
Well, go back a year when the 11-year something bull market ended, and then we're in a bear market, and what was it? 6 weeks?
Are you talking about 2020?
Yeah, I'm sorry, not last year. I say last. Yeah, 2020.
Yeah.
What year is this now? Well, it's the same kind of thing, right? I mean, that was it. That was the end of everything.
Now I'm wondering, because it used to be that the average time frame from the peak of the market to the trough of the market was a year and a half-ish, 2 years. And then it took 5, 6, 7, 8, 10, sometimes 10, 11 years to recover back to where you were at the pre-high, or the high before the downturn. In the last couple of downturns, it's recovered quite quickly. I mean, you look at the 2020, that was a true correction.
It was. Yeah.
But
it was a bear market, is what it was. We went on.
It was a bear market.
The bull market ended. Yeah,
and it was back up to even by August or September, maybe.
Yeah, by the end of the year. Yeah,
4 or 5 months.
Yeah,
I mean, it took 6 weeks to get to the bottom and 12 weeks to recover. So I don't know the exact numbers, but something like that. We had a correction, in 2019, just before that.
Toward the end of the year, 2018, I think, toward the end of the year. Yeah.
That didn't take very much time to recover. We had a correction earlier this year, 2022, and as of the time we're taping this, we haven't recovered from that all the way, but we're way off the bottom.
Absolutely,
we're more than halfway back. Who knows where we'll be tomorrow?
Think of all the people who had panicked on one or more of each of those events.
Well, yeah,
where they jumped out and they sold off and they said, "This is it."
We're looking at the invasion of Ukraine and saying, okay, it's starting. This is going to be bad for the market. We're getting the heck out of Dodge. The market's, at least it is of today, positive like 5 or 6% from that date.
Yes.
But that should have been something that sent the markets just dropping through the floor.
But you see, here's the thing, though. Do we care?
We do and we don't. We care. We obviously care. Because nobody likes to see red ink on their statements, and nobody likes to see that volatility on the negative side. But
from a psychological standpoint,
but psychological, one of the biggest things about financial planning is trying to control, the uncontrollable, one of those things, but trying to reduce risk. And one of the biggest risks to your portfolio is you. Behavioral finance side of this is tremendous. I mean, yes, we all think that we can withstand the volatility when the market's up 10%, 12%, 15%, whatever the number is. And then when it's down, we get a little gut check. And maybe I've seen it many times where, especially as you get older, as you get closer to actually needing the money, it's one thing to say, I can withstand a downturn of 40% when you're 25. When your downturn of 40% means you lose $150.
Well, even if you lost more than that, you don't need the money for 40
It's in your IRA. You're not going to use it for 50 years.
Right. You can't even access it without penalty for at least 30 years.
Yeah. So it's a matter of, but when you're getting closer to retirement, and you've done your math, and you say at 4%, I can retire today
with this number,
with whatever the 4%, whether it's 4% of 100,000, 4%, the 4% rule, all that, make it 5%, whatever. But all of a sudden the market goes down 10%, 15%, not even into bear market territory, just over a little correction. The want, the desire to, start wrapping your arms around the money by, making it safer, pulling some money out. That's the worst time to sell when it's down 15 or 20%. Sure, it could go down 25. But if you don't need to spend it in the near future, if you do need to spend it in the near future, you shouldn't have been in something that could go down like that.
Right.
And B, if you've done it right and you don't need to spend it for a period of time,
turn your back on it. Turn it off. Change the channel. Don't look at it. If you don't need it, why would you care?
Of course, that means that you have enough other income.
Either
from a job that you're not going to lose, from a source of capital that's not going to go down, from cash that is a dollar is a dollar is a dollar.
Right.
That presupposes that you've taken care of your income needs for that period of time, whatever that period of time is. A lot of times when we talk to somebody who's going to retire 6-7 years from now and they've got a stable job, they are what we would call bucket number one. They are the income that they need to spend over the next 6-7 years, number of years.
This is your job, is what this is, your income. This is why we do buckets.
This is why and how do you set up an allocation? People say, what is the appropriate asset allocation for me? Well, you're 60 years old, you should be 40% in bonds or 60% in bonds. I always get that rule backwards. Is it 100 minus your age is the
amount of stock
is the amount of stocks you should have?
Sure, because if you're 20,
if you're 100, that you should have no stocks.
Okay, obviously this is not true. None of that is true.
So, but that also presupposes that every 60-year-old has the exact same needs from their portfolio,
which they don't.
So, we need something that can tell us how to allocate appropriately. So what investments should we have? Have I got the greatest investment for you? Well, you don't even know me. Yeah, but I got a great investment.
It's good for everybody.
Everybody should have. No, let's find out what you are trying to accomplish and then backfill it with the appropriate investments for the need. Now, we've already talked about if you don't need the money for a long time, well, then you can invest in assets that have volatility and have the potential for getting a pretty good growth rate. That doesn't mean it's going to happen every year. And then we've already talked about it. It could go down and up and down and up and all over the place, up 20, 30% one year, down 15, 20%.
It probably will.
And if it's going to, and if you're in your 401k or something like that, you want it to so that you can dollar cost average. But if I need to spend the money next year, the following year, can I accept that kind of risk? Can I accept the fact that if I put in $1 today, it may only be worth 95 cents a year, 2 years, 3 years from now when I need to spend it? Can I go to my mortgage company and say, instead of sending you $1,000, which is my payment, I'm going to send you $950 and call it even for today?
Yeah, because my stock portfolio is down and I can't.
They don't seem to do that with me.
They don't like that.
The gas and electric company doesn't seem to go with that either. In fact, prices have gone up on that. Oh
no, they will send somebody out to your home perhaps with a wrench and turn off the gas and shut off the electricity.
I would imagine they could probably do that from not coming to your home anymore.
They probably don't need. Although I think the gas actually has to be shut off.
Well, I know there's a gas shut off at the house, but
there's a water shut off too, and I think the water company can come out and actually put a lock on that. I do believe. I don't know. I haven't experienced that. Fortunately,
no, I haven't either.
I have not experienced that. But either way,
but how do you set up? How do you set up the appropriate allocation? If you can't rely on the old rule of thumb, 100 minus your age or 105 minus your age or whatever those rules are, how do you set up? You set it up based on your spending needs. You set it up based on how much cash flow do I need to pull from this portfolio and when? And it's not necessarily going to be a static number each and every year, even ignoring inflation and the fact that you might need a little bit more as time goes on. A lot of times income comes in at different times. I may be retiring today and my Social Security won't start for another couple of years, or a pension doesn't start for a couple of years, or my house gets paid off in a couple of years and that payment, my need goes down. So maybe my incomes are all in place right now. I've already started my Social Security. I've already started my pension, and I still need $3,000 a month over and above that. But 8 years from now, my mortgage is paid off, and that's $2,000. So instead of needing $3,000 a month, I only need $1,000 plus some inflation.
This is just one example of hundreds that could happen.
The idea is you need to figure out what your need is and then backfill it with the appropriate investments. Now, we have segmented the assets to make it a little bit simpler into what we call buckets. And it's just time segmenting the need and looking at assets that I need in the short distance, near future, I can't take a lot of risk with. If I need to spend $50,000 a year for my portfolio, I need $50,000. I don't want it to be 40. I don't want it to be something less. I don't ever want to be I don't want to be put in a position where I have to sell something when the markets or my portfolio is down. Or I don't want to be in a position where the portfolio dictates what I can spend. Meaning if the market goes down and my portfolio's less, then I have to back off on my spending.
Then I have to tell the mortgage company I can't pay them all.
More likely, I'd have to tell my grandkids I can't help them with their school. I can't help them. I can't go to visit them. I can't do this, that, and the other thing. Can't do on vacations. Those are the things you have to cut out. The fun parts of life are what you cut out if you're living on that kind of a plan.
And we don't like that.
I don't like to cut the fun out. I'd actually like to increase.
Well, that's
the
why
amount
you
of fun.
plan. I heard just this morning a podcast where this particular advisor was saying, buckets. It's needlessly. I think he said it's needlessly complicated.
I may have listened to the same one you heard.
Did you hear that? Yeah, you may have heard that.
It wasn't from today. It was from it was a broadcast from.
Oh, that's right.
Ago.
I heard it today. It was from a year and a half or so ago. Maybe it was mid 2020.
But I heard it again in the last week or so.
Right. Okay. So you know what I'm talking about. This person had said that the question came in. Well, I know I should have CDs and cash and et cetera and liquid stuff in bucket 1, but what about bucket 2 and 3? And as I recall, this individual said, well, it's needlessly complicated. You don't even need a 2 and 3. You have a year's worth of cash. Have a year's worth of cash
for emergencies.
Says I call it emergency cash, and have a year of spending, and after that is just the rest of your portfolio. How about
And he said you should do He goes, you can be as simple as a total bond market index and a total world stock market index.
Right.
Okay, now, he didn't identify in what percentage. He said it could be 60-40, 50-50, 70-30, 30-70. How do you decide that? He goes, whatever you're comfortable with. And it's like, okay, that's not really helping me, because there's a lot of times that people are very comfortable being very aggressive when they shouldn't be. Yeah. And on the other side, people are very comfortable in CDs when they really need to have some growth in their portfolio. So just what you're comfortable with is needlessly complex. So how do you go about figuring out? And also, we were talking about earlier, now, recently, the markets have recovered quicker than they have in the past, but does that mean it'll always be that way? Average downtime in a downturn of a market is 18 months, give or take.
Right.
So if I have a year's cash on the sidelines that I can spend while the market's going down,
1 year,
that gets me pretty close to the bottom. So now I have to sell when it's pretty close to the bottom of where it's going to be. That doesn't help me at all. Now I just broke one of my earlier rules. Never be in a position where I have to sell something when it's a negative position.
Yeah, how can you possibly have just a single year's worth of emergency cash or
spending cash?
It's spending cash. It's your income, your short-term needs for 1 year. How can that possibly be enough? I mean, I looked at
and given interest rates and dividend rates, even though interest rates have gone up, there is not enough cash being generated from the interest and the dividends to live on just the interest and dividends alone. Not unless I'm living on a 2%-ish type distribution from my portfolio. Now, on the other hand, if you have $1 million and you only need $10,000 a year, almost anything will work.
Of course.
But if you're a more traditional retiree that needs maybe a little bit more from their portfolio, maybe 5%, even 6% in many cases, how are you going to make that work for you if all I have is enough cash on the sidelines to get me to the bottom? Now, the psychological aspect of that is dangerous as all get out, because what happens is when the market's going down and you're looking at your need from that market when it's down and you're getting really close to that, you're more likely to sell out, not just the money you need to spend for the next year. It's that psychological behavioral issue. I've got to sell even more because who knows how long this is going to be on. And at the beginning of the Russian invasion of Ukraine, did we really think that the market was going to go up from there over the next 2 months?
how about the next year? A lot of people were thinking it was to be the next year. It was going to be down.
Maybe it goes back down if it gets worse.
It might. I don't know.
I say worse from somebody sitting 10,000 miles away from it.
Yeah,
it's pretty worse if you're close to it.
Yeah.
There. Yeah. So how do you set yourself up? 1 year of cash, and this is there. Whether it's this individual radio show guy,
podcaster, I believe,
or whether it's a writer for a big mutual fund website, they say 1 to 2 years in cash. Well, 2 years is better than 1 because now it gets you maybe to the start of the upswing, but you're still potentially in a position where the markets are negative. I mean, look at what happened in 2008.
Or 2000 to 2000.
3 bad years in a row.
Absolutely.
And then it took 10 years for the index to get back from where it was in 99 to 2009.
Yeah.
I mean, so if you were trying to replenish at any time there. Now, it's not that buckets is the simplest thing in the world. It's not a set it and forget it. The nice thing about what this person was talking about was set it and forget it. You just every year pull the money you need out of it and rebalance to the thing. You can set that up with a computer and have it done automatically. It doesn't mean you're going to make a positive return. I will say, though, that it probably means you'll get a positive return in almost every year. But
every year?
Probably almost. But every once in a while, you're going to have a bad year. And if your bad year is the second, third, or fourth year that you're doing this, it could have a dramatic effect on the portfolio for the rest of your life. We've talked about sequence of returns. That's where that comes in. If your negative returns happen in the not-too-distant future, it can affect your entire future. Although on the other side, if a negative return doesn't happen for 10 or 15 years, hey, do you want to worry about that? Because you cannot, I have not met anybody yet who can predict with any amount of certainty what happens over the short term 4, 5, 6, 7 year period of time, 10-year period of time.
Well, because even if it will work almost every time doing it in a systematic way, that one time where it doesn't is where it really the effects can be devastating.
Murphy comes into play.
Somebody says, "Hey, Russian roulette, you got only a 1 in 6 chance of of things going wrong. It could be the first time you do it." The point is that it's devastating to your portfolio, especially as you said, when it happens early on in retirement.
And so the hard part about the buckets is not how to set them up. We know how to set them up. Have enough safe money to get you 5 or 6 years, maybe 7 years. Have a moderate account to help refill that. That's where the complexity in buckets comes in. When do you refill bucket number 1 as you're getting closer to spending that down? Because you are spending principal and interest out of bucket number 1. And your bucket number 3 is designed for a 12 to 15-year time horizon. But does it mean you have to leave it alone for 12 or 15 years? The reality is you need to be monitoring on an annual basis or even more frequently, even every other year. Where am I at? How is the market doing? When you set your portfolio up, and this is something very few people do, they should be setting an expectation. How much do I think that this portfolio is going to grow over X period of time? And if you're buying individual stocks, you should have a price point in mind that you're going to sell it. If I'm buying it for $10, I either have a time commitment that I'm going to put to it, or I'm going to have a price point, or I'm analyzing the underlying fundamentals and the technicals, not the technicals, but the fundamentals to see if anything changes at the company that means I should either get out or get more into it. But you need to have something in mind. But with the portfolios, it's generally a rate of return. A stock portfolio, maybe you think, I should be averaging 9 or 10% on this stock portfolio. My bucket number 3, the long-term money. Maybe the middle bucket is a balanced portfolio. There are other investments. Maybe it's structured capital notes. Maybe it's some other things, depending upon your aggressive or conservative nature. What do I expect to achieve from these? And then how is my bucket number 1 invested? Am I invested in laddered CDs where I know that $1 is $1 is $1, and I know what the interest is going to be? Probably isn't very good right now, but you know exactly what it is.
Yep.
That means you can probably go a little longer on your bucket before replenishing because you're not worried about any kind of variability in your return there. But it's a matter of, when do I replenish? Well, if I expect a 9 or 10% rate of return in my stock portfolio and it's up like it was in 2019, 30%, 25%. Mm-hmm. Well, last time I did math, 25% was a lot more than my expected 10.
Sure.
Maybe I take some or all of that excess returns at that time and take them off and refill some bucket. Even it's only been a year since I set it up. I can do some replenishing of bucket number one at that time.
And buy yourself some time?
And then re-stretch my bucket again. Re-stretch my bucket number one. Stretch out my time horizon again. Because, the markets go up and they go down. They go up and they down. And when they get way kilter off on the upside, they tend to give some of it back. Not tomorrow necessarily, but at some point. And I haven't anybody that knows when that top of the market is. On the other side, when it's down quite a bit, that's when people really want to get out. That's when people should be getting in. But we're looking at taking opportunity from the markets to replenish bucket number one. Or if I use bucket number two to replenish bucket number one, when do I replenish bucket number two? From 3? When it's in my advantage to do it, me being the investor. Not when it's detrimental because the market's down. Rule number 1, I don't want to sell something when it's in a negative position. But if it's in a positive position, specifically a positive position much higher than I expected it to be.
Yeah.
If you'd been doing this all along, when the markets went down in 2020, you weren't upset at all. You're like, oh, it worked. And then in 2022, at the beginning of this year, when it went down with 10, 12%, give or take.
Yeah, about
15
10,
maybe. Yeah. You were like, okay, that's why I monitor. That's why or my advisor helps me. And that's also why it's not automatic, because you don't want to just automatically set it or on the 25th day of every quarter, or set your quarters up. It's going to automatically rebalance. Well, maybe that's not a good time. Yeah. It's just one of those things that, okay, it's not set it and forget it. It's not the easiest thing in the world. It's not difficult, but it's not something that you can just turn your back on.
Well, listening to this person's podcast made it sound like it is easy.
Well, it can be if you're good with the ability to cut your income.
You mean if you're okay to say, well, the markets are down this year, I'm going to cut my income.
That's one way to do it. Or I'm not good. That's one option. The other is I'm not going to take any income until the market comes back.
Well, that's cutting your income.
Oh, yeah, cutting it to zero. Yeah. Okay.
Yeah.
So you either cut it as you can maintain your percentage as the beginning of the year balance, or you cut it all until you get back to where you were. I don't like either one of those approaches.
I don't know many people that can really do that. And if they can do that, then they've got other income sources.
Right. And I mean, we run into people who don't need their portfolios. And the reality is they're the hardest people to help invest, because they've got no goals for it other than, I want it to grow, I want it to be tax-free, and I want it to be guaranteed. Yeah, like those three are going to go together. That doesn't
somebody
happen.
who doesn't need it is probably for their beneficiaries.
For their heirs, yeah.
And
so how do you set up a portfolio for somebody who has no physical need from the portfolio?
Yeah.
And
so how do you address people who go out and whether it's podcast hosts or whether it's journalists who go out and say, nah, it's needlessly complicated. It's as simple as just rebalancing. I mean, you've debunked that over the last 10 minutes here.
It does work a lot of the time the way they're talking about it. But
you mean doing it the easy, quote unquote,
doing
easy
it the easy way. And if you've been the person that always seems to land, on your feet no matter what happens, and you don't have any distant relative named Murphy, where their law comes into play.
Yeah.
Then you'll probably be fine. Me, on the other hand, I am Murphy's Law incarnate. I mean, if it can go wrong, it will go wrong.
Well, you're exaggerating, but I know what you mean. It doesn't go right. I don't know anybody where it goes right for everybody all the time. I mean, there are people who have gambled their way into a fortune, but there are lottery winners too.
Yeah.
So it doesn't mean that.
And I'm not one of them, darn it.
Well, no. And so I hear things like that.
It can work. It's simple.
But it can work until it doesn't.
It works great until it doesn't. Mm-hmm. And when it doesn't, it's not just the market conditions that go against you. It's your own emotions that go against you, because our emotions, especially if you don't have a plan of action, and doing it the way this gentleman was talking about is not a plan of action.
It's just
put it out there and deal with it. If you don't have a plan, when things go wrong, you tend to
here's what happened.
Do bad things to yourself.
Well, here's what would happen. Let's say I had a year of, let's say I did what this person had said. I got a year of cash. I'm retired, and I got a year, and so for the next year I can pay my bills. And then I go from January, so I got through December, but in November, let's say we have a big downturn again. We lose 20%.
Oh, like we did in 2018.
In 2018, that's
where
a
it was
perfect
down
example.
Almost 20%.
It was like 19.9 or some.
We were so close to a bear market, but we didn't get it.
We were right on the edge.
Just before Christmas,
right?
When we really wanted to spend some money, the market was down almost 20% year to date.
Well,
high to low.
Right. Well, I've spent almost all my cash per this person's suggestion because I was only supposed to have 1 year of emergency cash, 1 year of spending. Well, I need some cash for January because I got a mortgage to pay.
Right. So do I only pull out 1 month worth of money?
Where am I going to go? Yeah. What am I supposed to do? My portfolio...
It's been dropping steadily for
the last 6 weeks or whatever.
Yeah, whatever, 3 months, 2 months. Am I just going to pull out enough for the next month? Or am I going to say, you know what, this thing, there's no end in sight. At that time, nobody was talking about it being.
Well, you don't know when it could have been another.
It could have been another year or two. But so I'm going to pull out maybe a couple years this time.
Of 2 years.
Yeah, 2 years. But I just pulled out 2 years, which turned out to be the bottom of the market.
I just sold off. So I get to December and I say, oh my gosh, I'm out of cash. My portfolio's down 19. Well, it wouldn't be down, but let's say
at that point
it was down 20.
It was down almost 20%.
Let's say I'm down 20% as well because it's all cash or all stock.
And then you pulled out. You were spending the proverbial 4%.
Yes,
but now it's not 4% when you're pulling out. You're pulling 5% out
or whatever.
So now I'm pulling 2 years worth out, 10%. So now I've pulled out 30% of my portfolio.
Because I want 2 years of
because I'm afraid.
One year wasn't enough. That moron told me 1 year.
So now I'm afraid. So I just pulled 30% out of the market.
Yes.
Yeah.
And it was at the bottom.
And now it's got to come back 30% to get me back to what he thought would be even.
I sold low.
Yeah. Unfortunately, we do that. And when people tend to that, they don't want to do 2 years worth of income. Now they're realizing, oh, maybe those guys on the radio talked about 5 or 6 years was right. And so they're pulling big chunks out.
Yeah.
Or they're pulling all of it out because they don't want it to go to zero.
You've heard that too.
I've heard that. I've seen that from other people. And it's just, you never want to be in a position where you have to sell something when it's in a negative. You only want to be able to take advantage of the market. The problem is I don't know when that's going to be. And that's why we do what we do. We create the cash flow. If anything, it might be a little on the conservative side for some markets. But that tends to only be a problem if all you're trying to do is get the biggest return possible.
And I think it's a fool's game, Professor Plum, my opinion, to do that. People hate losing money more than they enjoy making money.
And the person that is trying to get the biggest return possible at the same time taking money out of the portfolio is asking for trouble.
Well, so in a buckets type, which is not needlessly complicated, I don't believe.
It's not difficult. Where the complication comes in is something that this podcast host didn't
even address
at all, and that's the taxes.
Yeah.
How do we make this tax efficient? How do we pull? And he kind of addressed it by saying the old tried and true, use your personal money first. Don't touch the Roth ever if you can avoid it, and only touch the IRAs if you have them when you become.
He said taxable first,
and then
personal, and then
taxable's personal money, then IRAs, and then a Roth.
I thought he said IRA first. Oh, what did he?
No, he was talking about taxable accounts first,
personal accounts
first,
and then IRA,
and then IRA, then Roth IRA.
Oh, okay, all right.
Yeah, so that's not always. Now you can set it up that way, but if you're going to do that, you also need to talk about doing conversions.
Yeah.
Don't waste good. And low tax brackets
this
are
guy
good.
Didn't even mention conversion.
That's the complexity.
Yeah.
And that's not the allocation is straightforward. How much do you need to spend? Let's set it up. We can argue whether you have 5 years worth of bucket number one, 6 years, 7 years. Mm-hmm. The more aggressive individual will have a little bit shorter bucket number one, not 1 year, not 2 years, but maybe 4 or 5 years. The more conservative investor may have a longer bucket number one, maybe 8 or 9, 10 years even. I've had people say, look at 10-year bucket number one, 10-year bucket number two. I'm 65. If I make it to 85, I'm good with the market for 20 years.
Well, and bucket one doesn't have to be cash. No. All of it. If you could ladder or you could bucketize that.
Once you do the broad category of bucket 1, 2, and 3, then you get into the smaller, the micro issue where you actually bucketize the bucket, which
this podcast host described as gimmicky, by the way.
Right, and so it's just. Bucketizing bucket number one may just be laddering bonds. laddering CDs.
That's done all the time.
Yeah, that's nothing new. That's been done a long time. It may be, multiple different types of investments, that have the appropriate liquidity at the appropriate time. Just because I need to spend, $10,000 a year doesn't mean, I want a 7-year bucket. Doesn't mean I have $70,000 in a money market account that I can access tomorrow. I may have a 2-year CD. I may have a 3-year fixed annuity that outpays the CDs. I may have, you could do different things.
Sure.
The bottom line is, does it give me the guarantee or the near guarantee that I want? Does it give me a rate of return that's competitive with what's happening here? Does it give me the liquidity? Liquidity meaning available to cash without a penalty or without a loss, where I want it, when I want it. Does it meet my needs for this money? Does it meet the need of growth, big-time, long-term growth? No, because that's not what it's being set up for. It's being set up for a short-term need. I don't want to use a long-term asset, a volatile stock or mutual fund, to cover a short-term need.
Like paying your mortgage next month.
Yeah. On the other hand, I don't need to use a short-term guaranteed asset to cover something that I don't have to spend for 15, 20 years.
Yeah.
You need to match the need to the appropriate investment to the need that you have. Your needs are pretty much set. The investments can be lots of different things. Set the appropriate investment to your need.
Mm-hmm. Well, as you said, the idea of buckets is not, the allocation is really not that complicated. You back into it using the numbers.
You take emotion out of it. You say, what is my need? Now, there are times where somebody needs to get a little bit better rate of return out of their portfolio than they're comfortable with if they want to maintain that spending. Maybe they've got a 6 or 7% distribution rate that isn't going to drop in another couple of years because their mortgage is paid off. And so they can't afford to be 100% in CDs.
Yes.
And then on the other side, I have met people that have very large portfolios that have no need and really like the idea of never seeing a negative number. They can afford the volatility of the market. They don't want, and so they don't need to invest for growth. Even though they don't need to spend the money for 15 or 20 years, and they could do a stock market type investment.
They don't want to see red ink.
They don't want to invest that way. Their needs don't match their assets because they don't need them to. Whereas other people, they may need to take a little more risk with their portfolio than they want to be able to achieve the goals they want. Now, as long as they're within reason, and it may be just their feelings. I mean, I don't want to sit there and say, well, yeah, let's cut it down to 2 years of spending because you need it. This may have a deeper discussion where we need to talk about your needs.
Yeah.
Because your portfolio cannot support your need. And I've unfortunately had these discussions. Somebody comes in with, I remember somebody called on the air a couple of years back and said, I've got $300,000. I'm retiring tomorrow, and I need 40,000, $40,000 a year.
I
remember
out of it. That. Yeah.
And it was like, and you're in great health. Your family's got great longevity.
I could live 40 years.
Yeah. It's like, well, this portfolio is going to be, to get a 10% distribution each and every year. It's you can't count on the market, because when you're taking that much out, when the markets go down to 10 or 15%, you're just going to shoot yourself in the foot.
Right.
And you never give it a chance to really recover, even when just in a good year. I mean, it's hard to get better years than that at times. It was, his need was not,
I would love to know how this particular podcast host would answer to this answer, how they would address everything that you brought up. Because to me, I mean, the complicated part, as you said, is more often has to do with the behavioral with tax management and all that other stuff that you
taxes get complex. We can say that.
Well, they do, but mean,
it gets complex regardless of your asset allocation.
Well, we did. We talked last week about inheriting things. I mean, when you get the basics of inheriting assets, really isn't that complicated. If you have, it goes from one generation to the next. But if you really want to give yourself advantages and not pay more in taxes than you otherwise would have to, well, then maybe it needs to be a little bit somewhat complicated.
And we've seen plans that were very simple. Mm-hmm. And they put enough money in bucket number one to live off for the next X number of years. And they read everything, they did everything, and they basically created a ticking time bomb from taxation. They were in a zero or no tax bracket for the next 6, 7, 8 years. because they were living off personal money, and that personal money was invested very conservatively, so they didn't worry about the markets. And then when they got older, they had the required minimum distributions. They finally turned on their Social Security. Now they got all this income, more income than they needed.
Yep.
But they got a lot of taxes going forward,
and
which was unnecessary because they could have done it differently and reduced the taxes quite a bit for their entire lifetime.
And it was too late to do anything about it.
By then,
at
it
that
might
point.
be too late.
It could very well be, which is why you plan, which is why...
Plan. I guess
Planning.
there are good four-letter words.
This is one of them, the four-letter plan word. This is what we do. This is what you do, Professor Rick Plum. You're a certified financial planner,
Yes.
professional. This is, I mean, you can complain that it's needlessly complicated. You can complain that a jet engine is needlessly complicated because you can achieve the same effect by blowing up a balloon and letting it go. But there are reasons.
I want to get there a little quicker than that.
Well, yeah, but there are underlying reasons why certain types need to be looked at.
Going broke can be complex too.
Well, it can, and that's the whole idea. If you'd like to talk to Professor Plum about this, if you've ever heard somebody who says, "Well, buckets, I don't like it's much easier than that," and you say, "Well, this person seemed to be making some good points." Check with Professor Plum or listen to this podcast again.
Well, that person talked about it can be as simple as having these two funds. But he said, but we don't do that for our clients.
That was the other
we
thing.
do all of this portfolio
we do
management.
small cap, I have international,
value.
I have small cap. Yeah, I mean, they just threw everything right out the window.
If it can be that simple, why don't you do it that simple?
Because it isn't that simple.
He doesn't believe in is what he was saying either.
Well, this is what kind of you have to take some of these people that tell you these things. Just, I hate to use the grain of salt, but that's kind of what you have to do. What they're saying is trying to simplify it. I can make things simple for you. The truth of the matter is, Professor, everybody's situation is different psychologically, from a needs standpoint, from an investment, from a risk tolerance standpoint. You can't just say everybody should do it this way.
Right, because you maybe have the same need as somebody else, X amount of dollars, but your portfolio is a different size.
Absolutely.
Or it's a different makeup between Roth, personal, and IRA, which means you have different tax situation.
You want to get in touch with Professor Plum, 800-644-1150. Actually, that's the folks at Lucia Capital Group. Any one of the advisors can do exactly what you were just talking about.
Oh, yes. Yeah. We're all...
Everyone works under the same umbrella, and you're actually kind of the umbrella, Professor Plum. When you think about it,
I do need to lose some weight. I cast a lot of shade.
I wasn't going that direction, but where I was going was you are involved in a lot of the advisors' meetings anyway.
Yes,
and you certainly look over everybody's plan. Portfolio, make sure, this is all correct. This is the way I would do it. You can meet with people and say, well, what if we did it this way? What if we did it that way? But the
truth, discussion on my drive into work today with one of the advisors. We were discussing a plan, just talking about different.
I see it all the time. Yeah. In fact, I think twice during this podcast, you had a couple of people calling just to make sure. Yeah, exactly. But this is so. If you want to talk about this stuff about buckets, understand that you're in good hands because Professor Plum is on top of all of this, as are all the advisors. I mean, you guys meet not to find out information. You guys meet to collaborate.
We do.
And that's exactly what it is. Everybody's on the same page, in other words. They all put the plans together like this.
Yeah, we all use the buckets.
Yes,
we all use...
it's a brain trust. It's a team. Yeah. It's a team approach.
Team effort.
And Professor Plum is the Chief Financial Planning Officer. 800-644-1150, the number at Lucia Capital Group, 800-644-1150. Also go online at luciacap.com, LUCIACAP.com. We have years worth of videos and blog posts and all this other stuff you can read, get some more information, talk to the advisors. And hey, you know what? If you want to know about whether you can retire now or do you have to wait another 5 or 6 years, maybe you can retire now. There are other strategies. Social Security, we haven't even mentioned that yet. That was another element that they didn't get into. But anyway, that's for another time. Also, you want to learn more about our podcast, you want to download us, subscribe to it. Spotify is where you go. Spotify, and take care of that one way or another. We'd love to have regular listeners. If you have any questions for us, certainly you can email us as well. Go to luciacap.com. Professor Plum, thank you so much. I love it when people try to, not criticize what we say, but when they try to tell you it's not necessary, yes, because we just spent the last 35 minutes telling you let's see you answer to that. All right, let's see the answer to that. Again, 800-644-1150. For Professor Plum, Certified Financial Planner, Professional, I'm Johnny Dean, podcast host. Thanks so much for listening, and we will, of course, talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as a receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Information on investment products is for informational purposes only and does not constitute an investment recommendation or a solicitation to buy or sell the investment products described herein. Any investments or strategies referenced herein do not take into account the investment objectives, financial situation, or particular needs of any specific person. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. ETFs are subject to market fluctuation and the risks of their underlying investments. ETFs are subject to management fees and other expenses. Unlike mutual funds, ETF shares are bought and sold at market price, which may be higher or lower than their NAV and are not individually redeemed from the fund. Before investing, carefully consider an ETF's, a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. S&P 500 Index is an unmanaged index and includes a representative sample of large cap U.S. companies in leading industries. An investment may not be made directly in an index. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk. Bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall, financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. Money market mutual funds, though traditionally lacking federal insurance and not without risk, are highly regulated under federal law. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties, and if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.